All right, why don't we kick in? I want to thank the panelists for taking the time out to have what I'm confident will be a robust conversation. The purpose of and of course the audience for participating, and I would remind the audience to feel that this is interactive. And as we'll talk about a little later, just you got questions, you have different experiences, we want to share those amongst ourselves and talk about them. I'm Victor Boyage, and I lead our venture technology and emerging growth companies practice. I'm excited about this call that we have with our friends on the panel pulled together. The reason for pulling this together was a recognition that emerging fund managers and, quite frankly, smaller funds generally, where they may have 25 to 50 million under management as opposed to 25 billion, have different needs and market sensitivities and business sensitivities. So I think this conversation will be helpful for those of you who are in those two categories, as we again tease out where markets are going and some of the business issues and business thinking around the table. I want to turn it over to my partners, Chris Kula, who leads our fund practice here at Dentons, which is a global law firm, which is actually the largest law firm in the world, and Chris Errico, who is the chair of our startup program and comes into contact with a lot of not only startups, but CEOs looking to deploy their capital in many different ways, including new funds. Chris Square.
Sure. Thank you, Victor. Probably makes sense just to have each panelist introduce themselves, maybe to spend 30-40 seconds introducing your fund and what your mandate is, so to speak. Henry, you want to kick it off?
Sure. Hey everybody, my name is Henry Elkus. I'm the founder and CEO of an organization called Helena. It's a bit of a unique structure. I started it about 7.5, 8 years ago, sophomore year at Yale in my dorm room. And the purpose is, step one, search for potential solutions to large-scale societal problems. Step two, conduct due diligence on them to figure out if they should be implemented or not. And then step three, the hard part, try to implement them. And we set up a structure that actually started as a nonprofit that now has kind of 3 different buckets: a for-profit entity, a nonprofit entity, and the legislative arm. And they all do the same thing, which is those 3 steps, project by project. One of the things that makes us a bit unique is that for the first 5 years, we actually ran it solely as a nonprofit, got that to scale, built our team, made that autonomous, built a network of about 150 world leaders from across many different spaces as Helena members. And then with 2 of our members, Ray Chambers and Alan Schwartz, Alan's the chairman of Guggenheim Partners, and Ray's one of the great philanthropists around, we started a for-profit, did about $50 million worth of deal-by-deal SPVs and just closed our first fund at 108 million a couple of weeks ago. And we're just about 2.5 years old, have a very concentrated strategy where we will usually do Series A, try to lead deals, do $10 to $20 million checks, low diversification, but high conviction on each investment, and invest in companies that we think of the dual outcome of top tier venture returns, even if you're not considering the impact side of it. And if you're not considering the venture return side, the impact has to be non-BS, and it really has to be something that we feel is addressing a critical societal problem. So that's what we're doing. And now 7.5, 8 years in, kind of managing these 3 different buckets, it's at greater and greater scale.
Okay, why don't we pick it up with Bennett? Why don't you go, if you could go off mute next, it'd be great.
Thanks, Chris. Hey, Bennett Cohen here, Managing Director at Closed Loop Partners. Closed Loop Partners is an investment firm focused on the circular economy theme. And we have a range of different activities under the same roof here. On one side, we have the Center for the Circular Economy, which is really our innovation center, mostly a consulting model that works with Fortune 100s on bottlenecks, opportunities when it comes to recycling targets or circular economy targets. We also have an operating company called the Circular Services, which is the largest privately held recycling company in the US. And then we have an asset management and investment business, which is where I live, where we invest within the circular economy theme, everything from pre-seed and seed stage investments through core venture capital and growth equity. And we also have a buyout strategy. And we are we're often launching new strategies and new funds, including at the moment. And so have had the opportunity to work with several folks at Dentons on some of those new funds as we've been putting those together.
Excellent. I guess, Danny, you want to go next?
Sure. Hey, everyone. Excited to be here. Thanks for having me. I'm not working at a fund, but I do work at a fund administrator called Juniper Square. We have built technology touch points for all the LP and GP touch points to assist in the reporting out to investors for managers. And then we have an in-house technology suite to assist with the GPs interacting with us, the administrator, as we're working alongside groups. So we work with venture capital firms, large and small. I get to speak with lots of folks, so excited to share a little bit of what I hear in the market as well.
Great. And last but not least, Lauren.
Thanks, Chris. Lauren Brown, managing partner at Encore Equity. Formerly, I was founder and CEO of a company called Operative, which is a contract management and billing SaaS company for digital media and television. We sold it to a leveraged buyout firm called Francisco Partners for just under 200 million in 2017. I learned a lot about venture capital and private equity over that period of time, and inspired me to start this business where we're investing in Series A, business to business SaaS companies. Our TAM is what I'm calling horizontal vertical. We're looking at big macros, fast running rivers of money where there's lots of middlemen, nice disruption opportunities, and specifically ability to change a company's business model when we make the investment from, really 2.0 or 3.0 to 4.0. And I can sort of explain more about that later. We're also looking for coachable CEOs. So, really vertically agnostic, even though we will, in our emerging fund that we're doing now, be a little bit more vertically targeted, but long-term vertically agnostic, horizontally specific. And we are a operator-led firm. So you can't join the firm as a partner or an employee unless you've been part of a 4X exit or better outcome. 6 partners currently in the firm have averaged 6X in their exits and sort of our collective experience. And we're really trying to change the game. We think the VC market is ripe for disruption. So we're creating a platform to service the fund that comes with, bottled playbooks, bottled experience, bottled capital planning, and really leveraging the power of the, operators that work at the firm, but also the investors who are mainly CEOs who have had exits as well. So we're being very careful as we go through our fundraising to not reach too high into the institutional LPs. So I look forward to this conversation.
Yeah, that's great. And just to recap, as Victor mentioned, I'm a partner in the fund formation group. I primarily focus on fund formation of various different strategies, including venture capital, private equity, and real estate, as well as just private capital raising activities and venture capital transactions. So thanks to everybody for the intros, giving a sense of what you're, where you come from, what you're working on. I think in terms of like the next steps and the topics to be discussed, maybe we should start kind of with, there's a definition of what an emerging manager kind of really is. I think there's a, it's a little bit of a squishy definition, but in general, when I'm thinking at least of emerging managers, I'm thinking of managers worked on maybe their first 1 to 2 to 3 funds. And typically will be assets under management of, anywhere from, usually below 500 million to kind of more, even lower than that in the VC space. Sometimes it's higher in the PE space. It may be up to just under $1 billion, but usually it's, newer entrants into the marketplace. And I think this panel is more going to focus really on, probably the emerging managers are, just starting out, looking to either spin out from a VC fund or firm or just, coming back and starting up a VC platform.
So hopefully this will be helpful for everyone in the audience. I think to start things off before we kind of wade into a broader discussion here, just given that, all of you are constantly touching the market in correspondence with your LPs, probably would be good to just get a little bit of the pulse of the market. Obviously, it's a little bit of a turbulent market, but I think maybe just to kind of start off, it would be great to hear from each of the panelists, just kind of state of the market, what you're hearing from your LPs. Some of you I know are in a fundraising process, so might be helpful for the audience to just kind of get a market check.
Yeah, I mean, I'm happy to go first. As we thought about our value proposition, we were very deliberate in terms of how we approached the market, who we approached. And I guess the benefit of starting a fund in this environment is you can take advantage of, the current sort of way things are. And so we think that the, sort of venture capital, especially early stage, is ripe for disruption. We think that the 2 and 20 model's broken. We think VC, especially Series A, is undersupported. We think that, fund LPs typically lean into financial personas. That can be a challenge in terms of like money being distributed. And most funds below private equity also have passive boards. So we think that's an issue in early stage VC. And we also see that stage is linear to experience, right? There's more experience later and less experience earlier. And so everyone in the Series A space, at least the space that we're focused on, they don't address those issues. And so we are very specific to the market in terms of, one, who we're going to. We're not going after big institutions that are used to 2 and 20 models. LPs that are bigger want everyone, if they're used to doing deals in their alternative investment bucket with green duck business models, and a yellow duck comes out, they're not going to want to make an investment. So we are being extremely conscious of that. And we are going with where our niche is, which is to go after CEOs who have had exits, who have money, and really cater to their passion on the topics that we are trying to instill into these companies, which is really around commercial model optimization, teamwork, leadership, science, culture, and operational scale. And so CEOs appreciate that, and they feel they can be active. And so our fundraising is going extremely well because we're being very specific on what we want to do and who we want to target. And many of those people have had experience in early stage venture. They know it's been an undersupported market, so they want to get in. And it's been a pretty effective process so far.
Lauren, can I ask you a question? Aren't you finding and meeting with skepticism in market? Because you've done this for the first time. It's not like you have the historical track record. And so, again, a lot of the folks on the call are in your shoes or are going to be jumping into your shoes shortly. And so I'd love to just get a sense of what you're encountering in market when you come up with this new proposition without a track record. Because it's a fabulous idea.
Yeah, like anything, building momentum starts with your inner circle, and we have, 6 people in the firm with outstanding track records. Al Sabloy, for example, took Tango public, had a 10x, took Butterfly only 5 years ago from $0 to just under $300 million valuation and acquisition by Partners Group. And we've got 3 or 4 other people like that in the firm, including myself, who have delivered huge returns. And so we're all starting with our sort of primary networks, right? We're getting people under the tent that trust us and getting those people involved in many things, not just sort of, here's an LP agreement, we're going to make you, 5X or more, and it's going to be great. It's more around like, here's our strategy. Here's how you can play a role. Here are the playbooks we're taking to market. Here's how we're approaching the fundraising process. Here's how we're talking to CEOs, the types of CEOs we're looking for, and really trying to get them engaged in that process. And what happens is, that person comes in, and then Victor, when you're sort of building momentum or pipeline, you really got to take advantage of, those synergies and the niche that you're involved with. And it's not a good fit for everyone. Some people you talk to are just like, this sounds great, but I got some money in other funds. When that frees up, I'll maybe consider this, which is a nice way for people to say no. But if you don't get enough no's, then you're certainly not going to get there.
Any thoughts, Danny? You seeing anything interesting on the fund administration side in terms of fundraising market?
Yeah, sure. So I think a lot of folks agree that people don't want to miss this vintage. Everyone agrees that the vintages of the last year or two are going to be looked down pretty poorly. And so everyone's sort of turning their focus to, hey, like these vintages are going to be great. But what folks hear, or I hear through folks we speak to, is that LPs, depending on who you're speaking with, either feel over allocated or still just kind of nervous because they've gotten burned so hard on the last couple of funds. And so I think it is resulting in managers raising slower and raising smaller funds than they anticipated, which it seems to be like the new normal. There's kind of two dichotomies. If you are this is like the non-emerging, truly established, doing great, it's a little bit of business as usual, and your large institutional LPs are probably re-upping. But if you are emerging, it's definitely sort of a steeper hill to climb. I think that one lesson that I've heard of GPs who are raising in this market, who are more emerging, is that their talk tracks have had to gear more financial and more sort of leveled up, as opposed to being a story of the industry and innovation, et cetera. LPs want to hear about, what is the plan for, like, what are your thoughts on where the public markets will be in the next 2 or 3 years, which will impact your entry levels and your expectations. So hearing a lot of like needing to not just tell the story of like being broad, but being a little bit more tactical. And then I think having a diverse LP bases is a huge thing too. So again, when you're emerging manager, hopefully you've got sort of the core family and friends, kind of the day one investors, and then always building different like tranches of LP relationships from there. When you're truly emerging, you're not going to be making the jump to institutions quite yet, but to the extent that you can start to have conversations with family offices, et cetera, just to build out different pools of investor relations that you can need down the line. Those are some of the areas that we hear folks focusing on.
That makes a lot of sense, and something you touched on is very important to focus on here, especially in this environment, is a vintage year, right? If the fundraising environment is definitely on the slower side, but the opportunity in terms of lower valuations for portfolio companies, being able to hit the market kind of in a counter-cyclical period and be in position, really, if you can be in position to raise a fund now, and then be able to deploy that capital, presumably at lower valuations. I mean, that could bear very well for vintage, funds that are formed in the next, year or two for those vintages. So I think, that's an important point to make. And I think the other point you mentioned about, understanding your LP base and kind of how you're going to approach, the approach to fundraising, it's critical to have your, whether it be friend, what is your target? What's your target LP base? Are you going to rely on, institutional backing if that's possible, if you're spinning out from a financial institution? There are other, programs even too for emerging managers that are available, for example, from certain pensions and whatnot. And on the other end of the scale, if you have a good network of family office, high net worth, that's obviously a good place to start. Even in terms of developing a track record and whether or not that's portable, and that's obviously a key consideration too.
Yeah,
Go for
all
it.
right. I guess I will just jump because I wanted to make this one point. So sorry, I'll just say the one is another thing that speaking with GPs is the transition to like running a sales funnel is like, especially emerging managers, they're, probably deal junkies and don't want to be as focused on operating in the business. And, maybe you learn it, maybe you partner with someone who can help. But at the end of the day, the fundraising process is going to be a sales funnel. And so like simple principles of, literally just being organized and having some sort of CRM that you can track conversations. And then the concept of having sort of like 2x in your pipeline or 3x if your target is, $50 million, be having conversations with $100 million so that if someone drops out, you can put someone in. So it's switching your mentality, especially nowadays where it is harder to sort of running like a true traditional funnel of like, okay, spoken with these folks, expressed interest and like, getting some actual signatures.
Yeah, I
Yeah,
guess I would agree with a lot of the comments on this so far. I think picking up on something you mentioned, Chris, about kind of the unfortunate reality that when it's hard to raise money, that's the best time to be putting it to work. And when it's easy to raise money, that's the worst time to be putting it to work. And so I think one of the things I'm focused on right now is putting money to work, whatever that looks like, because this is going to be great vintages, to your point, Danny. And, statistically, it's just a great deal making environment. So whether that fund you were going out to raise isn't as big or it doesn't look exactly like you thought, I think the important thing is to be putting money in the market right now and thinking long term, because when you're back in market for your next fund and the fund after that, 7, 8, 9, 10 years from now, you're going to be pointing back to these deals that you did get done in 2023. And hopefully, kicking out a gear from that emerging manager category into being more established. And so I think, if you can do a first close and get to work, I think that just makes everything more real, more tangible. And you start, putting points on the board in a market that is going to reflect very well, down the road, I expect.
Yeah, that's a great point. Even if you're in a position where you have to do deal by deal or a fundless sponsor model just to get a track record, and that turns on the track record question, obviously, and portability of your track record. But if you're in a position to have the portable track record and be able to launch, commingled fund with true outside money, that's great. But even in the other scenario where maybe you're not ready for that and you're going to approach it via deal by deal or fund the sponsor model, and you can still generate based on the valuations, you can still start to get build a track record before you actually go out and get the institutional or other capital.
Yeah, it's very different than running a real company. Not to say a fund isn't real, but when you're managing a business and you have a management team, you have a pretty specific focus and you're doing things a very particular way. What I'm learning in this fund model is there's like a million plates to spin, right? And like Bennett said, like I couldn't agree with that more. Like get your first close done, which we're like about a month out from doing. We've got a nice pipeline. We're going to get some deals to work. And and all the advice I get is to sort of keep bringing it back to that one simple concept, because you could really be distracted along the way. I mean, Henry, you've been at this a while. You probably have seen something similar.
Yeah, no. As I'm hearing you guys talk, what's going on in my head is I'm trying to bifurcate what is not unique and historical about what is going on. And we've hit a lot of those. So just to go through those, like market cycles are not unique to us. I don't have the muscle memory personally of being through multiple. My experience is seeing the tail end of the peak of the market cycle, huge amounts of capital allocation to stupid valuations based upon greater fool theory thinking. And then of course there is no greater fool. And then you have massive markdowns, and you see what's now happening to Tiger having to dump their stuff on the secondaries. You see what's happening to SoftBank. And then of course now the beginning of a new market cycle, or maybe the bottom of the last one and the initiation of the new one. And I think the same principles, as always, you see this every 10, 15 years, are hold true. So one of them, I think, LPs are really looking at due diligence processes in this vintage much more closely than they are looking at access, networking, and hype. With the possible exception of AI startups, which are having their kind of their beginning of their own cycle, which is really fascinating to watch because we're seeing valuations that are unsustainably high in that space right now, even though no other space is seeing those. So you have that. I think the other thing that's worth noting is in this environment, future financing risk is an enormous risk for any early stage startup, whether they can even raise a B or C round is a massive risk that didn't exist for a lot of great, even good companies in the last cycle. And so one's ability to actually safeguard against that because you have a growth fund is a huge premium right now. And the issue is a lot of the growth funds are down 80%, 90% right now, and their LPs won't give them any more money. And so that I've noted that as a particular phenomenon that's happening.
Henry, how does that relate to or impact the smaller fund? Again, it doesn't necessarily have the dry powder to get a company through a drought.
Yeah, I think part of it is going to be industry selection. So if you're getting pitched a nuclear fusion company and you're going to do the seed of that company, and the company is going to require $2 billion of capex to get to scale, and you don't have the juice to write those bigger checks, you're really going to hope that Temasek and the Saudis are going to come in later. And if you don't have those relationships and you can't actually stack that confidence, you may want to look away from those types of industries. Whereas in the last kind of market cycle, when there was hype around those and those checks were flying, you could have a higher confidence. And then going back to what works is these really high cash flow certainty that the business is going to work earlier on models. And typically, one of my best companies right now in our portfolio is in the climate space, but it's a B2B SaaS AI company. And they have, they're raising a B right now and they have 7 years of runway left. And they're totally in the driver's seat. They have, their balance sheet's great. And there's a lot of confidence. And you can see these kind of tier A VC firms circling around them, willing to pay a high price. And so for those companies, I think it's been, what I wanted to say though, is I want to just challenge us to think about, okay, what is different this time around in this moment in economic history that you can't actually repeat. And I would just posit one thing, which is, and obviously I'm talking my own book because I'm an impact investor, but you see something like, for example, solar and wind, where the John Doerrs of the world in the early 2000s actually did something quite philanthropic, even though they didn't want to make it philanthropic, which is they lost a metric crap ton of money on clean tech investing. And what that really did is it put a lot of money into reducing the expensiveness of a lot of these products to the point where they're now profitable. So the cost curve of a lot of these kind of hard technology impact companies, especially in climate, is going down, while the acuity of the problem and the amount of commitments that are being made by the Microsofts and the Apples of the world and the kind of the large companies of the world, as well as government, is going up. And you see this actually really beautiful kind of Venn diagram that's overlapping now. And what I would say is that I think this is a great time to really look at impact investing, where I would hope that some of the return profiles of the right companies, were you to choose them, are in no way concessionary. And that is the first time in history in which this is the case. I don't think it was the case 10, 20 years ago, because public sentiment, the average B2C kind of buyer is now selecting for plastics that are biodegradable, in the way that they weren't before. And so those spaces, I'm making a bet, are really good investments right now. So I would just throw that out into the table as something that is perhaps unique in this cycle that hasn't been the case in priors.
So just to kind of keep on this thread, right? We heard Lauren talk about operator specific, right? Really kind of getting into what differentiates, what's unique about your firm, right? And it's operator heavy, operator centric. And Henry, you're kind of targeting Aon sector. What other types of things can emerging fund managers utilize or emphasize in their fundraising efforts to really further bolster that differentiator, right? If they're stacked up against a third or fourth time repeat fund operator, and they're in front of an institution that can allocate 10, 20, $30 million, how do you differentiate yourself from them? How do you prove, beyond just having an operating history, which is a little bit of a chicken and the egg type issue. But what can emerging fund managers do, or how did you guys in your fundraising efforts, how did you differentiate yourself? How did you convince them that it's worth taking that ride, or let's make that bet on you?
I'll just start it off. I would just say two things really quickly. The first is psychological, but important, and the second is operational. When you're a first-time manager and you don't have a track record, actually leaning into that and the incentives that you have versus a large fund, at least we've had success with. And so our pitch, both for landing deals, but also LPs, is we're going to go up against Andreessen and Sequoia for these deals. And oftentimes the partners that are at those firms that have the connections to really kingmake these companies are not going to be the ones leading the deal. It's going to be a junior partner that has an incentive structure, which is they really want a 3x, or in Lauren's case, 4x, not to make fun of you, the returns that they can make partner at Encore, for example. And they are beholden to that incentive structure. And what we will say is, no, our ass is on the line. This is our first fund. We simply cannot fail. And so we will spend way more time hunting this deal down and spending our time kingmaking it. And it'll come from the managing partner, not from the junior partner. And so that's why you should go with us. And that incentive structure, I think, had some success with our LPs. I think that's the first one. The second one is not in any way new, but it's, especially in this environment, is important, is can you bring customers and can you show that you've brought customers? It's a way to actually show track record without an economic result. As you can say, look at this company that we invested in the A. They did not have a 10 million plus ARR customer at the time. During our due diligence process, we went and we got them that customer, and that's where we won the deal. That's something that just takes a lot of blood, sweat, and tears to do as a GP, but it instantly differentiates you to an LP base, because you can say, that you're looking at these other funds. Did they pull that off? Did they bring in? Did they actually bring synthetic value to the businesses they're investing in before they wrote the check? And that's something that I think, if you can do that well in this environment, can win you points.
Yeah, I completely agree. I just to even double down on that, and I like that there being alignment between, sort of the CEO of the business as well as the LPs, and I think that in this market, you really got to show them something different, whether it's an LP or a CEO that stands out, right? And to us, it's really matching, helping them match value exchange with their customers' propensity to buy. And if you look at the history of software, I'll talk to our fund, the business model of software was once, all right, you host it and you pay more of a, CapEx oriented. There's an, sort of model that appreciates that over time or depreciates it. And then you had the next model was more of like a SaaS offering, which was really the subscription economy. And then you had, Siebel and SAP and Salesforce come in and start pitching more, value-based selling and sort of selling on the, different criteria and solution selling. And now we're moving more towards, what we like to think about as business model 4.0, where you're really lining up the value that in a way that leans toward the customer, essentially allowing the customer to buy on the outcome, as opposed to what we call, the 2-hour event, right? Where you're stacked up alongside 4 or 5 other vendors. Everyone sells on a seat license, which is, in my opinion, becoming the old way. And you make a selection based on essentially who's got the most features compared to the amount of OpEx. And that creates friction in the sales bookings process. And that's a huge issue, right? And if you're a CEO, former CEO that has a lot of experience, that really well. And if you're a CEO of a company that is trying to save the world or doing whatever founders try to do, they don't realize that friction is happening. And when you turn that light to those activities, people really start to perk up and they realize they're having a conversation with a fund manager that is starting to look and feel a lot more like someone that they need, that can show them the light, show them the way forward, as opposed to burning cycles. So I always tell them, we're going to evaluate you based on you being coachable, based on your market, based on your product, but you need to evaluate us. Are we the fund that can get you where you want to go twice as fast and double the amount of value that can be created? So if you think we can do that, go with us. If you don't, go get a check from somebody else that's not going to lean in, and that's fine. Not everyone has to be a fit.
Yeah, I mean, the thing I'm hearing and the takeaway really here is just you know, obviously differentiation, but also filling market gaps to the extent there's a market gap and you have the expertise to execute on that strategy, particularly in a difficult fundraising environment. That's seems to be one of the keys to potential success here. Yeah, so I think we could, you know, in terms of talking about, you know, not only the investment strategy, but even the infrastructure and the key considerations that you need to start up, you know, maybe we want to give some thought to, you know, the team and the human capital element of, you know, putting together a team for, particularly for an emerging manager, including, you know, where the team's coming from. For example, is it a spin out from a larger fund? Is it an experienced team where it's kind of balkanized and you have people coming from different funds, but they're working together for the first time? Or more in your case, you know, if you're spinning out as a CEO of a successful exit, you know, kind of, if you guys could just discuss a little bit your thoughts on, you know, what's the right recipe to putting together or having a good team to start out when you're an emerging manager, that'd be great.
Yeah, I mean, I'm certainly happy to start. For me, it was really about recognizing my strengths and maybe my weaknesses. You know, I'm really good building momentum, having conversations, pitching the vision, getting people bought in. But, you know, I also know that I've never run essentially like a consulting practice, even though it's going to be much more than that with experienced operators and playbooks. So I brought on a woman named Peyton Marcus as COO, who can really look after the platform, do some operations for the fund, but really be the one responsible for helping to integrate into these companies, you know. And I always tell these companies and their CEOs, like, we're not helpers or advisors. Like, if you want a helper or an advisor, you go with someone else. We're light bringers, right? We're showing people the way. We've got a very specific model in mind. And if they like it, then they're going to get excited. And they probably will if they start to, as they read the tea leaves of what we're describing in the world that they're in, and they're going to feel a little stuck, then they're going to know that's a good fit. And so that position was really important, not just to be able to deliver on the things that we said we're going to deliver on, but also help vet those deals. Like, it's one of the things at the private equity level that I learned when Operative, you know, is owned by a leveraged buyout firm. Lots of operators, lots of smart people at Francisco Partners, and they know exactly what to do to turn companies around or accelerate ones that are in really good shape. And they deliberately put those people alongside the deal team to pre-vet deals too. So I think it really just starts with, what are your strengths? What do you need to complement you? And then building a team around you, which for us includes fractional help, which I'm sure everyone here is looking at, but also experimenting with this EIR concept. You know, if you look at a lot of investment banks and other firms, they have EIRs that can allow people to come in who are very experienced, who want to work on deals, who can bring a lot to the table, who want a certain level of exposure. They can make some money or choose to, you know, get a piece of the carry. And so I think about that as a little different than an operating partner. It's kind of more of like building a network and having that network kind of almost be its own flywheel, if you will, to promote the company's values.
Yeah, I'll just go ahead.
Go for it, Henry.
I was just going to say, I think the brass tacks on this question is economic as well, which is how does a fund make money in the near term when there's no carry? It's your management fee. You have that money to spend, and it's a small amount, and you have a pool of carry to allocate to your early team. And this question is really, when you are too small to have everything that you want, what are you willing to not have to get there? If you're KKR, you can have whatever you want. You can have an entire bullpen of analysts. You can have whoever. You can have, you know, a 4-star general running your think tank. You can do whatever you want. If you're a 50 million AUM first-time fund, you can't. So I think what I would go to is just thinking from that mentality, what does my firm purport to do that is unique? And how can I hire specifically for that? How could I be the best in the world at that one function and prove that to my LPs so that I can scale and then I can fill everything in around? And the mistake there would be to hire somebody that doesn't solve that problem. And I think one of the polls that a lot of people have early on is they want to have a really good website team page that shows their kind of, they left Goldman to start this fund and they want to show their network that they've hired this amazing person that does this function. Turns out that person is way too expensive as a percentage of their available fee and carry. And they don't actually aid in landing a proprietary valuation at a great deal, bringing a customer to that company, and then showing your LPs that works. And oftentimes that person could be somebody that doesn't have the sparkling resume and may not be as expensive, but is somebody that you trust and you know has the network to help you. And if you can bring those folks on first, you have the dual benefit of also setting the culture that you want and not inserting egos early on into the process. And I don't think that, we've done this perfectly at all, but that was at least what was on our minds early on to kind of solve this chicken and egg issue.
Well said.
Yeah. That makes sense too. I mean, and you also have to think about just even, just the arrangement amongst the partners when you're first starting out. You mentioned carry splits or potential carry splits in economics. Getting the team in place so that you have the ManCo and the GP kind of set up and you have the right people at the steering wheel, so to speak, is pretty important. Certainly if you're going to build a platform around it. So, there's definitely some time allocated to doing that and searching and making sure you've got, not only the expertise, but also just, you have the infrastructure, the legal infrastructure in place too, to have partners up at the ManCo and GP level and have a baseline there so that you can go out, capital raise, and everyone's kind of marching in the same direction.
Hey, Chris, you said something that I just want to kind of put to the group. How do you guys think about allocation of time, right? Because and as Bennett kind of mentioned, you really have two full-time jobs. You have fundraising, which you're kind of doing for a large percentage of your time, but then you also have deal making, you have sourcing. So how do you think as GPs, how do you think about time allocation of how you allocate your time between this and how do you coordinate that? I mean, just I know that some of my young VCs that are kind of out on their own now are always getting kind of grilled by LPs on, well, how are you going to do everything, right? And who's going to do it? Is it, you have two GPs, you have three GPs, it's just you're a one GP shop. How do you have time to do it all? So I don't know if you guys have any thoughts there or you've kind of encountered that or.
Yeah, a couple reactions to that. So one is, I think, LPs don't want you spending all your time talking to other LPs, but they do want a lot of time. So it's one of those other unfortunate realities. But I think, at least in my experience, in kind of the early part of the initiative and kind of putting the story together and getting those first closes done, it's much heavier on the fundraising and LP networking side. And then hopefully, it sort of shifts and you get into the flow with your fund and you get at least a little bit of a break where you're more focused on the market and investing before you go back and kind of, start to go out for the next fund. I think the danger is if you spend all your time in those early cycles fundraising, you get a little stale, right? Like, what's happening in the market? What are the interesting companies you've seen? Like, you're talking to the same LP 3 months later. I think they really like to see that you're learning and they learn something new every time they talk to you. And you can definitely learn a lot of things from talking to LPs. But I found they're more interested in some of the insights that you get when you're in the trenches of the market. So I think just, never being out of the market is a good thing to remember, even when it feels like you don't have time, because you're really in the core of the fundraising. But that's been a little bit my experience through the process.
And that makes perfect sense. And that's a good point there, because fundraising is very intense. Obviously, deal flow, working on transactions is intense, Danny had mentioned something earlier about just have a plan, and you have to really have your plan kind of from the outset set, including, potentially, having the right, not only the right team, but even the right expertise in terms of, obviously service providers, financial assistance, so that the founder can basically focus on their, on fundraising, and also being in the market. So, you can't, I think practically speaking, it's very difficult to do both at once. I mean, you really have to kind of have your thesis set, and then go out to the market. There's still certain things you can tighten up, but, you don't want to be fundraising and not kind of, have everything all planned out and ready to go.
Chris Kula, just one quick observation, just as the folks on the panel were talking about, thinking about how to tap into the ecosystem, we even, as a law firm, try to do the same thing. We want to bring opportunities, whether it's money, it's successful CEOs, it's the family offices. We want to bring them to the table. We want to introduce our clients to the money. We also want to take economic risk, right? So if, for example, one of our CEOs who's kicking off a fund is not successful, there's that reality out there. We're going to bear some of the, downside pain, because otherwise, it's all the risk is on them. So again, just as all of the constituents around the table, if you build the right team, should have that same mentality coming into the fund itself. And we're always excited about getting involved with these folks. We like that entrepreneurial aspect of it, if you will, and adding real value.
I was just going to add one thing. It's never, I guess there's maybe some people have pulled this off, but the best academic answer to this question is to have LPs that when you talk to those LPs, it benefits your portfolio companies and your understanding of the market. And so it's not a zero-sum game. And what I try to do during my week that results in the best outcomes is call my LPs that actually own the companies that could be customers for the deals that I'm working on or for my portfolio companies. And then you knock out, obviously, the needed kind of TLC that you have with your LPs to show them what you're working on. But you walk away from that interaction saying, okay, I can raise an SPV with this guy's money to size up in my next deal. Okay, this guy is at Amazon. He can actually do a pilot program, and I can bring that value. And if you can rack up a system where you have a lot of those and you're successful there, then the next step is you go to that LP and you say, hey, I'm raising my next fund. Introduce me to your friends that have the exact same strategic value that you do. And I would rather prefer to get their money instead of others. Obviously, this is all easier said than done. And it's a bit of first mover ownership, but if you can pull that off, then you can construct a kind of 24-hour system every day where you're not wasting time, or you're not screwing over, the real fiduciary duty you have to your investors, which is to allocate their capital correctly and not just to make them feel good.
Yep. We call that a taxonomy, Henry. And that's not, and maybe everyone does, like it's essentially like a product catalog mapping, right? Like you got supply and demand, and or you might sort of macro it to like a Venn diagram, and you really do need to keep track of what are the things that the LPs do that can benefit the portfolio companies and vice versa. And in our case, we're dealing with CEOs on both sides, so it actually makes it very tight. So really doing the work up front in terms of what is it very specifically, you're going after, what are those use cases that really matter, get super duper focused, and entertain new ideas where you think there might be leads into sort of fit into those use case concepts. So doing a lot of upfront work, I think, is super valuable, bringing your LPs along for the ride, showing them that they could help, and sort of the pipeline, kind of does get developed on its own. And I think Denton's, to Victor, your point, does an amazing job at this too, having the benefit of sitting, it's, one of your annual events, just kind of seeing how you think about your customers, and you've actually mapped that out in a very, articulate series of slides. So yeah, it is not a new concept, but it's a very important concept to not just sort of spray yourself around, to sort of get like super focused in terms of your intention.
Yeah.
Lauren, are you bringing your CEO LPs into your early meetings, fundraising meetings to attract other LPs or meetings with CEOs?
Yeah, it's actually one of the things that I do a lot. So, you know, as we aim towards this first close, we have looked at a lot of different deals. And as we've gone through the process, and we have a couple of late stage that, you know, hopefully we'll get one or two of those done, investors with, you know, asking them for feedback. What do you like? What do you don't like? Has been extremely effective, because, you know, once you have that first call where they're like, okay, we're in, but the deal docs aren't ready yet, and we might not be ready to close. It has been a great way to sort of just kind of go back and forth and leverage those experiences. And because we're like horizontal across various verticals, and all of our CEOs come from many verticals, you know, that's back to that taxonomy sort of component. We can go draw from different experiences, and that keeps them engaged. So I know that if a deal is ready to close prior to our fund closing, I know that I can gather, you know, an SPV like sort of concept across several investors, and get that deal done. So it's a great way to keep the LPs warm, in our case. Not sure if it's the same for others.
Maybe we use this as opportunity. Danny, wanted to mention something or get your take on just kind of back to the putting the infrastructure in place point. What are you seeing? And this is all to all the panelists, really. What are you seeing in terms of kind of infrastructure from a technology, cybersecurity, and compliance perspective from the fund administration side? You know, how much should an emerging manager be thinking about, you know, getting that kind of getting that in place, and just give them a sense of general timing?
Yeah, you know, the basics of it is, you know, every manager needs 4.5 you know, supporting parties. They need legal support, they need administrative support, they need tax and audit support, they need a banker, and then the half point for the outsourced CFO and compliance and all that. So the order of operations, we actually see it sort of different times. Like sometimes we get the first call and say, hey, a new fund's come in, you know, can you help us get introduced to a handful of others? And then, you know, oftentimes we'll get pulled in from someone to switch over. So those are sort of the main components of it all. And, you know, whether you're one person or sort of a full team, you're going to need all those different components. The pieces of technology that we hear folks interested in a lot, some, of course, here at Juniper Square, we have like investor portals, data rooms, and digital subscription workflow. That's helpful to stay organized, and it's a good investor experience to do that digitally. On the side of stuff that we don't really help with, but is always like the question that we get is, hey, where can I get a, you know, portfolio analysis, a forecasting, scenario analysis tool across my portfolio to build reports? And there's sort of a handful of others. To be frank, Excel is still the leader in the market in that world, but there are definitely some good shops out there for that.
Well, just as I know we're coming up on time here, do we want, maybe it would be helpful if just kind of each panelist left, if you could give one piece of advice to a younger version of yourself who was kind of in the trenches on something like this, what would you leave kind of the audience with as kind of a one key takeaway? No, you're on mute, Ben.
Go with an easy one because I already said it, but I think just start investing, right? Start, even if it's smaller checks, or it's outside the fund structure that you're still working on, just like continuing to put money in the market and show, your track record and build it however scrappy way you can, and consistently, I think, is definitely a good thing to do, and helps really build momentum for your credibility when you're fundraising.
Get a life coach. And in all seriousness, these are hard jobs that we're all doing. And just like any executive or any job where you're managing multiple parties, lots of money, and the stakes are high. It can be confusing. You can kind of lose yourself a little bit. You can get over-indexed on outcomes and desires. And a lot of times you just got to recenter yourself. So spending time on your own mental wellness, and getting a coach, whether that's a business coach or a mindful coach, to sort of, be that graceful force that brings you back. And when I'm in that stage, which is also known as, the alpha brainwave state, lots of athletes are, also sort of, focusing a lot on this, and lots of CEOs I know. That's the best thinking state. That's sort of leveraging more of, the sort of the side of your brain that you don't use enough. And that does wonders for keeping your commitment and getting the people around you sort of to a good mental state as well. So that would be my advice.
I'm not an active investor, but I will take the liberty to provide an answer. I would say definitely what Bennett mentioned, like being in market. We work with a bunch of groups who started with just doing SPVs, and it, that becomes the like fund zero they point back to, or et cetera. And then I would say simplification, and the Denton's team, I'm sure like the law firms hear this, probably deal with it more as folks with like creative ideas. And look, if you want to be an investment manager, like lean on advisors to get you moving. Don't try to recreate the strategy of the industry, like fit into a lane properly to start. And when you become the next, John Doerr and want to get creative, go from there.
I would just say read. I think if you can outread your competition, it will have really, mental health benefits, pride, confidence. But if you can be in a conversation with a potential investment and have actually put the time in to respect their field by really learning it, as opposed to kind of parachuting in and learning on the spot, it's just an enormous amount of advantage. And I think the younger you are, the more important this is, because you really lack the reps and experience. And if you can synthetically insert that into your brain through books, it's just the biggest thing that's changed in my life since leaving college. And that's the first thing. I think the second thing is, if you can remove as many buzzwords from your communication as possible when talking to people, when talking to LPs, when talking to corporations, whatever it is, and communicate in a clear and concise way, it demonstrates that you actually understand the subject, as opposed to are trying to approximate that you understand the subject. And the more discerning crowds you get into, really sophisticated founders, really sophisticated LPs, top deals, you'll notice that it wins you really big points if you can be less complicated in how you act. And I wish that I had removed that part of myself earlier in my investing career.
Yeah, I think that's really great advice. I think we're at time, so thank you, each of you, for your thoughts and your time today. Your perspectives were very insightful. So this has been great.
And we've got another one coming, so more to follow. See you later in the summer.
Take care. Thanks all.